Hi. An old US comedian, one Will Rogers, said, "Making money in the market is easy. Buy a stock if it will go up. If it will not go up, don't buy it." Here comes a pause and a laugh. Because, of course, how can you tell if it will go up? That, of course, is the trick. Now, why do I mention this old truism? Because I want to recommend to you an investing book that attempts to do just that. No, not my book. I'll do that later. But someone else's book first. That book's name is 100 Baggers, written by Chris Meyer, Mayer. Great book, great name. In the book, Meyer dissects stocks that went up 100 times or more to see what were the secret that made them go up. The book is well written, very well researched, and practical, if you have the patience to do what it recommends, and the resolution to do nothing but. Which is doing what? Which is to find the rare stock that has the 100 beggar attributes and potential, then buy it and stick with it. Both parts are not easy to do. For the first part, Meyer gives you some well-tested criteria of picking the stocks. All are good. But the second one is, of course, the hardest. How do you stick with one stock for 30 or 40 years without being tempted to stray? It's just like marriage advice. Find the right partners and stick with him or her. Most advice are about the finding. But what about the sticking with? That's hard. What does Meyer say about that part? He says a few wise things. I won't summarize them. I don't want to cheat him out of readers. Just buy his book and read it. What I will do here, however, is take the main points he makes and tie them to what I try to do in my own investing. Then give you an example of one stock that may just be worth your sleuthing attention. In fact, two of Meyer's ideas are close to mine. The first, obviously, is his very healthy long-term bias. But second, he recommends deep due diligence, which is what helps you hold the stocks. He gives you criteria, all of which are good, whereas I focus mainly on ongoing physical due diligence well beyond written criteria. In my experience, that really is what helps you stick with a winner. Let me show you why by breaking the investing cost down to three parts. The three costs are money, aggravation, and time. Money is the result of years of work and saving, your work. If you lose the money, you'll have to work again to make some more. So don't lose it, which, by the way, is Buffett's first rule. Don't lose money. The second criteria is you also pay with aggravation, both during the sleuthing, but also later in the years of holding the stock as it fluctuates and give you a heartburn. But third and often forgotten is you pay with time, which is your most precious resource. Say you're 25 years old, planning to retire at 65, 40 years of work. At 50 weeks per year, say 2 weeks vacation, that's 2,000 weeks total. That's your time budget. So if you hold the stock for 10 years, you just spent 500 weeks of your 2,000, a full 25%. And if you hold it for 20 years, you just spent half. That time of yours will never come back. So you better choose the right stock to hold, because as time goes on, your fear of having made a mistake as the stock fluctuates grows bigger as your life ebbs away. So a temptation to cut corners on each of these three costs is very high. But if you try to cut corners, you won't go far. Don't cut corners on capital use by using margins or options. Don't cut on the aggravation of sleuthing, or you won't get exclusive knowledge. And if you try to get rich quick by trading, you'll fry your capital and get poorer and older. So what should you buy to hold for 20, 30 years or more? What are the criteria of a superior company? Meyer's book has some. I have a few others. But what either method demonstrates is that superior stocks are rare. So you better spend more of your precious time on looking for them and learning them rather than on succumbing to the latest fast trade. Sleuthing takes time. The question is, which stocks are worth it? How to choose? The naive answer is only the very best. But what is best? How to decide? Remember, time goes by. My first book, The Sleuth Investors, shows you how to sleuth. My second book, coming before year-end, I hope, The Advanced Sleuth Investor, shows you how to pick the worthiest stocks and also how to run a portfolio. It does this by comparing investing to several other disciplines like military intelligence, math, physics, brain science, chess, and gives you ways to sift for superior stocks. It's based on simple 3 points. The first one, a good business rides a long-term growth trend, so revenues grow fast. Second, good management gets a lot of these revenues down to the bottom line. The third, a good company manages to do this without using too much capital. In simple terms, high sales growth, high gross margins, and high return on capital, or in percent. Sum up these 3 factors and you get what I call the company greatness indicator, which you can simply call Q for quality. But how to know if a high Q company is worth your sleuthing time? Because, maybe it's too expensive right now. After all, you only have so many weeks before you retire. To find this, simply divide the company's Q by its EV to EBITDA. You'll get what I call the stock's greatness indicator, which we can call V for value. For a low EV to EBITDA, you get a higher V. That's it. That's the sleuth secret sifter, high quality and high value. Unless both quality and value are high, leave the stock alone. There are plenty others. If both are high, you can spend some time on it. Do I have any example of any such stocks? Yes. Here is one which may just be worth your sleuthing time today. The company is INMD, symbol INMD. The company makes and markets aesthetic medical devices using radio frequency, selling in the US and worldwide. The device do skin tightening, liposuction, and body and face contouring, skin rejuvenation, unwanted hair plucking, wrinkle reduction, and cellulite treatment. In short, INMD makes non-invasive machinery to help women look younger and more attractive for longer. How big is the market for this? Well, half of humanity really, or at least the half that can read the company literature and afford the treatment. The company was started in Israel, went public, and the stock began to rise. But then the virus hit and the stock fell then more 50%. But unlike the stock, the company kept doing well. In fact, in the last earnings call, it raised guidance since the market for the product is very buoyant. Why is it buoyant? Well, again, some aestheticians who use the machines to treat women spoke very frankly. And I'll have to be very careful here about what I choose to repeat. But here goes. 4 main reasons. First, women in the Western world are marrying later and having less children. Second, more of those who got married and got divorced stay divorced. Third, because of medical advances and healthy lifestyle, women are also living longer. So without family and with fewer children, women's need is, as one dermatologist put it, right in the shop window, make men desire you and women envy you. This need, if the trends above hold, can only get stronger. And with less financial commitments to family, the disposable income of independent, educated women is high and getting higher. That's INMD's market. But fourth, INMD sells its machinery to frontline dermatologists and other beauty practitioners for whom the machines are necessary to attract women customers and retain them. If I may use a comparison here, selling INMD machines to hair pluckers and skin tighteners is like selling CRM software to brokers, customer relationship management. Brokers are other professionals who sell attention besides selling performance. In sum, the trend of aging, wealthy women needing INMD's product to look younger and attractive for longer is bound to get stronger as time goes on. But don't take my word for it. Go check it out for yourself. Ask beauticians and aestheticians, but be careful how you phrase it, or you offend them. What of the stock? Both its Q number, the sum of sales growth, gross margin, and return on capital, and its value number, dividing the former by EV to EBITDA, are very high. In fact, they are the second highest in my universe of stocks. Which is the highest? Well, that's Taiwan Semiconductor, TSMC, the company that Warren Buffett just bought a big chunk of. But that's another story. So is INMD worth buying? I never recommend either a buy or a sell. I can only point out a stock as perhaps worth spending some sleuthing time on, as INMD probably is. That's all for today. Please let me know in the comments below what you think of the above, and if you like it, give it a like and subscribe. Then resend to your friends so they subscribe too. Then buy my book, The Sleuth Investor, and give it a review on Amazon, which I hope will be a good one. I'll see you next time, and meantime, thank you very much for watching.